Welcome. In this lecture, we are going to study one of the most important questions in corporate finance. How should a firm choose its capital structure? Capital structure means the mix of debt, equity, and other financing sources a firm uses to support its assets. At first, the topic may sound simple. Debt often appears cheaper than equity, so why not use more debt? But finance is rarely that simple. Debt changes risk, it changes incentives, it changes the claims on cash flows. It can create tax benefits, but it can also create financial pressure. A useful way to think about this topic is to separate value creation from value division. Value creation comes mainly from investment decisions, choosing assets, projects, and strategies that increase the value of the firm. Value division is about how that value is shared among shareholders, lenders, governments, managers, and other claimants. In perfect markets, changing the way the pie is sliced does not change the size of the pie. But in real markets, taxes, distress costs, agency conflicts, information problems, and financing constraints can make capital structure matter. So the key question is not simply, is debt cheaper than equity? The better question is, when do the benefits of additional debt become smaller than the costs created by additional financial risk? That is the roadmap for today's lecture. Let's begin with the perfect capital market benchmark. A benchmark is useful because it gives us a clean starting point. It does not claim that the real world is perfect. Instead, it helps us understand what would have to be true for financing decisions not to matter. In a perfect capital market, there are no corporate taxes, no personal taxes, no transaction costs, no issuance costs, no bankruptcy costs, no financial distress costs, no asymmetric information, and no agency conflicts. Investors and firms can borrow and lend on the same terms. Also, the firm's investment policy is fixed. That means the firm's assets and operating decisions do not change just because the firm changes its financing mix. Under these assumptions, financing policy only reallocates cash flows. It does not create or destroy total firm value. This is a powerful idea. It says that if the operating assets are the same, and the total risk of those assets is the same, then changing the mix of debt and equity does not magically make the firm more valuable. Why is this benchmark useful? Because once we understand the perfect market result, we know exactly where to look for real-world capital structure effects. If capital structure matters, it must be because one or more perfect market assumptions fail. Taxes matter because interest may receive favorable treatment. Distress costs matter because debt creates required payments. Agency conflicts matter because financing changes incentives. Information asymmetry matters because securities can be mispriced. The perfect market benchmark is therefore not the final answer. It is the clean laboratory that helps us understand the real-world answer. Now we turn to Modigliani and Miller framework without taxes. The basic framework result says that under perfect capital market assumptions, the total value of the firm does not depend on whether the firm is financed with debt or equity. This can feel surprising. Many people look at debt and say debt has a lower required return than equity, so debt must make the firm cheaper to finance. But that conclusion misses the risk adjustment. Debt usually has a lower required return because it is safer. Debt has priority. Debt holders receive promised payments before shareholders receive residual cash flows. Equity is riskier because shareholders receive what is left after other claims are paid. When a firm adds debt, the debt holders take a safer claim, but the remaining equity becomes more exposed to the firm's operating risk. The shareholders now bear more risk per share of equity. Because of that higher risk, shareholders require a higher expected return. So the lower required return on debt is offset by the higher required return on equity. The firm has not reduced the risk of its operating assets. It has only redistributed that risk between lenders and shareholders. This is why the weighted average cost of capital remains tied to the risk of the firm's assets under the assumptions. The labels may change, the securities may change, but the underlying asset risk does not disappear. The lesson is simple but very important. Debt is not truly cheap if its use makes the remaining equity more expensive because shareholders are bearing more financial risk. The intuition behind is often explained with the pie theory. Imagine the firm's operating assets as a pie. The size of the pie represents the total value created by the firm's assets and investment policy. Financing decisions determine how the pie is sliced between debt holders and shareholders. In a perfect market, slicing the pie differently does not make the pie bigger. Giving debt holders a fixed slice and shareholders a residual slice changes who receives which cash flows, but it does not change the total cash flows generated by the assets. This also helps us understand why higher expected shareholder returns do not automatically mean higher firm value. Leverage can increase expected returns to equity because it concentrates risk on a smaller equity base. But higher expected return is compensation for higher risk. It is not necessarily value creation. Also relies on the idea of homemade leverage. If investors can borrow and lend on their own account, they can adjust leverage personally. An investor who wants more risk can borrow personally and buy shares. An investor who wants less risk can hold less equity and more safer securities. The point is not that homemade leverage works perfectly in real life. The point is conceptual. If investors can freely create or undo leverage themselves, they will not pay extra for a firm simply because it chooses a particular debt ratio. This is why the argument is based on arbitrage logic. If two firms have the same operating assets but different financing structures, investors can create equivalent payoffs. In perfect markets, equivalent payoffs should have the same value. Let's now introduce corporate taxes. Taxes change the analysis because interest expense is often deductible at the corporate level. Dividends and share repurchases are not treated the same way. This creates a potential advantage for debt financing. The value created by interest deductibility is called the interest tax shield. The idea is straightforward. When a firm pays interest, that interest can reduce taxable income. Lower taxable income means lower taxes paid by the firm. Lower taxes mean more cash flow available to investors. So once corporate taxes are introduced, debt can increase firm value. Not because debt changes the operating assets, but because the tax system allows the firm to keep more of the cash flow those assets generate. This also changes how we interpret the cost of debt. The effective cost of debt to the firm is reduced by the tax benefit of interest deductibility. That is why the after-tax cost of debt appears in the weighted average cost of capital framework. However, we must be careful. If taxes were the only real-world fiction, the conclusion would be extreme. Firms should use as much debt as possible, but real firms do not usually do that, and for good reason. The firm must have taxable income to use the tax shield effectively. The debt must be serviceable. Tax rules may limit deductibility. Personal taxes may affect investor preferences. Most importantly, additional debt increases financial risk. So taxes provide an important benefit of debt, but they do not give us the full capital structure answer. To complete the picture, we need to bring in financial distress. Debt creates required payments. That is both its strength and its danger. When the firm has difficulty meeting its obligations, it may enter financial distress. Financial distress does not require a formal bankruptcy filing. A firm can be distressed whenever leverage pressures its operating decisions, investment choices, financing flexibility, or competitive strategy. Bankruptcy costs are usually divided into direct and indirect costs. Direct costs include legal fees, advisory fees, court costs, restructuring expenses, administrative costs, and time spent negotiating with creditors. But indirect distress costs are often the bigger managerial concern. These costs can appear before formal bankruptcy. Customers may worry about service quality. Suppliers may tighten credit terms. Employees may leave because they are uncertain about the firm's future. Managers may delay valuable investments. Assets may be sold under pressure. Competitors may take advantage of the firm's weakened position. These effects can reduce firm value even when creditors are eventually paid. The expected cost of financial distress depends on two broad ideas: how likely distress is, and how costly distress would be if it occurred. As leverage rises, both can increase. The firm becomes more likely to experience pressure, and the consequences of that pressure may become more severe. This is why managers should not view debt only through the lens of tax benefits. The value of the tax shield must be compared with the present value of expected distress costs. Debt can be useful. Debt can be valuable. But too much debt can damage the very operating business that financing is supposed to support. This brings us to the trade-off theory of capital structure. The trade-off theory says that firms choose capital structure by balancing the benefits of debt against the costs of debt. The main benefit is the value of interest tax shields. The main costs are expected financial distress costs and agency costs. At low levels of debt, the benefit of additional debt may be greater than the added expected cost. In that range, more debt can increase firm value. But as leverage becomes higher, the expected costs of debt begin to rise. Financial distress becomes more likely. The firm may lose flexibility. Creditors may demand stronger protections. Managers may become constrained. Eventually, the marginal cost of more debt can exceed the marginal benefit. The optimal debt policy is reached when the extra benefit from additional debt is just balanced by the extra cost created by that debt. This theory helps explain why firms differ in their use of leverage. Firms with stable cash flows, tangible assets, and predictable taxable income can often support more debt. Their cash flows are easier to forecast. Their assets may be easier to pledge as collateral, and the tax shield may be more usable. Firms with volatile cash flows, intangible assets, high growth opportunities, or large future investment needs often use less debt. For them, distress can be especially costly because flexibility is valuable. The trade-off theory does not mean managers can identify one perfect debt ratio with precision. In practice, firms often think in terms of a target range that balances tax benefits, credit quality, investment flexibility, and tolerance for distress risk. Capital structure also matters because financing choices affect incentives. These are called agency problems. Agency problems arise when one group makes decisions that affect another group but does not bear all of the consequences. Debt can create conflicts between shareholders and creditors. Once debt is in place, shareholders may prefer actions that increase the value of equity while shifting some downside risk to creditors. One example is choosing riskier projects after debt has already been issued. Shareholders receive much of the upside if the risky project succeeds, while creditors may bear part of the downside if the firm weakens. Another problem is debt overhang. A firm may have a valuable investment opportunity, but shareholders may reject it if much of the benefit would go to existing creditors rather than to equity holders. Shareholders may also prefer cash payouts before distress, reducing the cushion available to creditors. Managers may defer maintenance or other necessary spending to preserve short-term cash, even if that increases long-term risk. Creditors understand these incentives. They respond by charging higher interest rates, requiring collateral, imposing covenants, limiting additional borrowing, or restricting payouts. These protections can reduce agency costs, but they can also reduce managerial flexibility. Debt can also reduce agency costs of equity. When firms generate substantial free cash flow, managers may be tempted to overinvest, build empires, or keep too much cash under their control. Debt can impose discipline by requiring regular payments. So debt has both incentive benefits and incentive costs. Moderate leverage can improve discipline. Excessive leverage can distort investment decisions and intensify conflicts with creditors. Let's now discuss asymmetric information and the pecking order theory. Asymmetric information exists when managers know more than outside investors about the firm's prospects, risks, or asset values. Because of this information gap, financing choices can send signals to the market. Equity issuance is especially sensitive to information problems. If managers believe the firm's shares are overvalued, issuing equity may be attractive because the firm can raise capital at a favorable price. If managers believe the shares are undervalued, issuing equity can be costly because existing shareholders give up ownership too cheaply. Outside investors understand this incentive. Therefore, an unexpected equity issue may be interpreted as a negative signal about management's view of firm value. Debt is often less information sensitive than equity because debt has a more fixed payoff. For firms with moderate default risk, debt investors are mainly concerned with whether the firm can make promised payments. Equity investors care about the full range of future upside and downside, which makes equity valuation more sensitive to private information. This leads to the pecking order theory. Firms tend to prefer internal financing first, debt financing next, and equity financing later. This theory differs from the trade-off theory. The trade-off theory emphasizes an optimal debt range based on taxes, distress costs, and agency costs. The pecking order theory emphasizes financing sequence and information costs. Both theories can be useful. A mature firm may have a target debt range, but still prefer internal cash for normal investments. A growth firm may avoid debt because distress is costly, but still issue equity when valuable investment opportunities require funding. Let's finish by connecting the theory to managerial decision-making. Capital structure theory is sometimes presented as if every firm should calculate a precise debt ratio. In practice, managers usually work with ranges, constraints, and judgment. There are good reasons for this. Future cash flows are uncertain, investment opportunities change, market conditions change, tax benefits may be uncertain, distress costs are hard to measure, industry benchmarks are imperfect. Adjusting capital structure can be costly because issuing, retiring, or refinancing securities involves fees, covenants, negotiation, and market timing concerns. A useful capital structure policy should help managers answer practical questions. How much debt can the firm support in a normal environment? How much can it support in a weak environment? How much unused debt capacity should be preserved for future opportunities or shocks? What financing sequence should the firm follow when internal cash is insufficient? Managers should also distinguish accounting capacity from economic capacity. A firm may appear able to borrow based on current earnings, but the deeper question is whether it can service debt under adverse conditions while continuing to invest in the business. This is why capital structure analysis combines quantitative ratios with qualitative judgment. WACC, leverage ratios, interest coverage, tax shields, and debt maturity all matter, but so do product market risk, customer confidence, employee retention, supplier relationships, asset flexibility, and access to capital markets. teaches us that leverage does not create value by itself. Tax shields explain a benefit of debt. Distress costs, agency costs, and information problems explain why debt is limited and why financing sequence matters. Thank you for joining me today. I'll see you in the next video.